Hello, it's Mark here with another video. As you're probably aware by now, there are rumors of high inflationary environment and a recession have gone from rumbling whispers to full-on alarm bells, and many, including myself, predicted that we'll most likely be in a recession by the end of this year. Now, although it's not official yet, it is likely that we'll be officially in a recession by the end of the summer. A rule for recession is negative GDP growth for 2 consecutive quarters, and we are well on our way to that. Being that here in the Americas, we've had a negative 1.5 GDP growth for the first quarter of 2022, and although the second quarter isn't over yet, the expectation is that we'll get that report of a negative GDP growth this quarter as well, officially placing us in a recessionary period. Now, talks of recession usually spark fear and overall negative sentiment, but it's not all doom and gloom, and you can still come out pretty well, and that's what we're going to discuss in this video. That is, how to manage your money in a recession to ensure that you don't get burned like a lot of other people. Don't worry, I got you. So let's get right into it, but before we do, you know what to do. Hit that like button below. It really makes me know what kind of video you guys like, so I can keep making more of that. So I'll wait for a little bit. All right, now that we have that out of the way, let's go. First thing you need to do is make sure you have a plan in place, because all financial plans have a long-term view in mind. Now, if you're only basing your spending habits on short-term views, you can find yourself in a world of trouble very quickly. Now, if you don't have a plan in place, now is a good time to start. When drawing out your plan, you need to consider the following. 1. Determine your goal. Now, before you say,
well, obviously the goal is to manage your money during a recession.
Just hear me out for a second. By goals, I mean, if there wasn't a recession looming, what are your financial goals? Knowing your goals will keep you focused and also help in deciding what sort of moves you want to make in preparing and managing your money on your journey towards these goals. Next, you want to determine your time horizon. Now, if you're saving up for a big purchase like a down payment, your time horizon might suffer from someone whose goal is to save for retirement, for example. Also, within this, age will also factor, as in a 20-year-old has a different investing time horizon when compared to a 50-year-old, for example. Now, as part of your planning, you also want to determine what type of investor you are. Now, if you have a goal as an investor, you want to determine what type of investor you're going to be. Do you want to be a person that's actively checking your investments daily, or are you more of an autopilot person? Do you want to trade often and buy and sell almost daily, or are you more of a buy and hold person? Are you willing to take more risk or more rewards, or are you willing to sacrifice exponential growth in favor of capital preservation on a more conservative growth rate? Now, these are the things that you need to consider as you draft up your plan. Now, knowing what type of investor you are and having a plan in place to align to your risk profile and your goals will help immensely, especially when there is a market downturn. The second thing you want to do is you want to build your emergency fund. I know I probably come off as a broken record because I've mentioned this in a lot of my videos, but it's really important. Now, it's very important, especially heading into a period of uncertainty, just like a recession. Now, a recession puts businesses in critical position, and a lot of businesses really have a hard time maintaining operations while managing their current costs. And some end up downsizing or even going out of business as a result. Now, having an emergency fund in place helps you to maintain your necessary expenses like food, shelter, utilities, and transportation if something unfavorable happens, like you lose your primary source of income. Next, after you've built up your emergency fund, it helps to have some cash on hand ready to deploy if you anticipate a recession happening soon. Now, when there is a recession, this usually results in the prices of investments like real estate and stocks taking a plunge. Having some cash on hand during this period allows you to take advantage of these depressed prices and set yourself up for long-term investment growth. Remember though, since it's a recession, it's hard to time the market, and timing the bottom is usually not recommended by most financial experts. The rule of thumb here is a dollar cost average during this period, and also on the way up for you to fully participate in the market recovery when it happens. Now, if you're more of a real estate investor, it's a little bit easier because you can look at market comparables to determine what real estate listings make sense for you to purchase during this period. Regardless, whatever asset you choose to invest in, the point here is to have some cash ready to take advantage of opportunities, because you never know when these opportunities are going to come. Remember, success is when opportunity meets preparation. So if you want to be successful, you got to make sure that you prepare so you can pounce on these opportunities when they do pop up. Next, remember to invest in recession-stable industries and companies. As an investor, you want to make sure that you're already investing in some industries that will keep you protected and limit your downside in the event of a market downturn. Sectors like consumer defensive, industrials, and also industries like telecoms, and to a lesser extent, the big banks. Emphasis on big bank. The bigger the bank, the less likely it is to fail. And when these banks raise interest rates, guess who also gets to take some of that profit since you're a shareholder? Yeah, you're welcome. I told you I got you. Anyway, next you want to diversify. Now, if you're a savvy investor, you're probably already diversified. Now, if you're not currently diversified, don't worry, you're still a savvy investor because I know you're gonna rearrange your portfolio and diversify after watching this video. Now, a diversified portfolio keeps you protected versus if you were into a heavy sector like tech. Now, speaking of tech, this is a sector that's usually hit the hardest during market fluctuations. So if you're 100% allocated in tech, chances are that you're already feeling the effects of the overall market movement. Now, the easiest way to diversify is to invest in a broad market ETF. Key word here being broad market. If you invest in a sector ETF, you're still not gonna be as diversified because guess what happens when that sector goes down? Your portfolio is going to go down as well. So it's best to diversify your investments across multiple sectors and multiple markets where possible. A well-diversified portfolio of stocks, ETFs, fixed income, and real estate is your best weapon against heavy financial losses. Now remember that not every recession will be as bad as a Great Recession. And even though there might be a lot of talks and overall fear in the market, the best way to ensure that you come out of it with minimum losses is to prepare. The better prepared you are, will increase the likelihood that you're able to successfully minimize losses and even increase your returns. If you found value out of this video, please drop a like below. Please share with a friend as it really helps out the channel as well. Thank you so much for watching, and with that, I'll end this video. I'll catch you in the next one. Peace.